Okay, whenever you're ready.
Good morning, accounting colleagues. My name is Thomas Vitale, and this is my partner, Nick Dolman. This morning, we will be critically analyzing one of the largest accounting frauds in history at WorldCom. In an era of corporate scandal, WorldCom typifies a cycle of pressure to hit Wall Street earnings, leading top management to engage their lower-level accounting employees to perform illicit accounting maneuvers in an attempt to hide their financial shortcomings.
This is a brief case outline of what we're going to discuss today. First, we're going to talk about the history of WorldCom, then the key players and their involvement in the fraud, the timeline of the fraud and the ethical issues involved with it. We're going to discuss case questions given to us and the result of litigation, which includes the settlement they were given and where they are today.
So a brief outline of the history of WorldCom. The telecommunications industry became deregulated in the early 1990s. It was a worldwide movement, so it wasn't just in the United States. And it was a very exciting innovation because now that it was deregulated, people thought there was big bucks to be had. So in 1996, the Telecommunications Act of 1996 opened capital to this newly competitive industry. So the big belief was that once the fiber optic networks, routers, satellites, and other telecommunications equipment were installed, they would then have almost pure profit because all of their infrastructure was in place. Everyone was very excited, which led to high growth. WorldCom grew to become the 25th largest company in the world in 2000. However, beginning in the 2000s, the industry had overexpanded as there was too many suppliers and there wasn't enough demand for their products. Vicious price wars and decreased revenues ensued. Facing the monumental losses from the industry shift, WorldCom management decided to engage in accounting fraud rather than to fairly present their losses. But by 2003, WorldCom had filed for bankruptcy. So we had presented our organizational chart for WorldCom to outline our key players. So Scott Sullivan was the CFO, and he was very well regarded and very talented as a CFO. And in 1998, he was voted as one of the country's top CFOs by CFO magazine. It is essential to this case to understand how well-respected and talented Scott Sullivan was in his job. Underneath him was the controller, David Myers, and he recruited Buford Yates, Director of General Accounting, to join WorldCom, as they had worked together previously at Lamar Life Insurance. Troy Norman, who's beneath him, is a native of Baton Rouge, Louisiana, and he oversaw accounting for WorldCom's fixed assets. Then we get to Betty Vinson, and she was living what could be considered the American dream. She lived in a quaint, manicured neighborhood, and she taught Sunday school, and she had a husband and a daughter. And in the office, she had a reputation for being hardworking and diligent, which led her to her promotion to the Director of Management Reporting.
All right, next, on the other side of the chart, we have Cynthia Cooper, who is the head of the internal audit. She's from Clinton, which is the town where WorldCom is from. She moved away to go to school, and she eventually moved back after a divorce. She started working at SkyTel until they were bought by WorldCom in 1994, and then she continued to work at WorldCom. She started the internal auditing department by convincing Evers that it would make the company more efficient, and he was all about being efficient and making profits. Next person we have is Gene Morse, who's kind of like the computer whiz. He's great with technology and finding out information. And last we have Glenn Smith, who's the senior manager underneath Cooper. And fun fact that his mom taught both Cooper and himself accounting at Clinton High School. And then we have the external auditors. First, it was Arthur Anderson. Their names were Melvin Dick and Kenny Avery. And then they ended up switching auditors after Enron to KPMG, and Farrell Malone was the guy in charge. And then here's a couple ethical questions to think about when we're discussing the case. First, just following orders is not an excuse to break the law. That was by James Comey, the prosecuting attorney. Second, low-level players who wound up being victims of unscrupulous high managers from the Wall Street Journal.
So this ethical question dilemma is essential to understanding this case, because you can look at the financial accountants in two lights. So there's one light which says that they had their bosses telling them what to do, they were confused, they didn't know how to handle it, and it wasn't exactly their fault. And then the other view, which ended up being the litigated view, was that just following orders is not an excuse to break the law. So while we're going through this case, keep those questions in mind to more understand the ethical dilemmas. Okay, so to set the timeline of fraud off, it began in the middle of the year 2000 when Bernie Evers, their CEO, and Scott Sullivan, their CFO, realized they were going to begin having losses. And this was, of course, as a result of the industry oversupply. Their long-distance contracts revenue was decreasing, while their line costs were increasing in relation to their revenue. Additionally, a large number of their small clients went bankrupt, and they weren't able to pay them back. So this resulted in $685 million in unpaid bills. So instead of admitting this financial shortcoming to the Wall Street investors, Sullivan came up with a scheme to use reserve accounts to pay for other expenses. And this amount totaled to $828 million. So Vincent and the other accountants knew this accounting entry was improper, as it requires management to A, expect a loss in the line costs, and B, there must be a good business reason to reduce it, and obviously making your financial statements look better is not a good business reason. Vincent and Norman, they informed Yates that they did not want to make the entries because they did not believe that they were ethical. However, Myers assured them that these entries would never happen again, so because of the pressure of their positions, they made the entries. And after making the entries, they planned to resign. They informed upper management that they were gonna quit. However, there was a big movement to keep them there, as Sullivan organized a meeting with both Vincent and with Norman, and he said that he would assume all responsibility in the case that this was to come out, and he additionally said, "Don't leave us during these bad times. Stay with us through the bad times. Once we get through the bad times, you can head out." So Vincent additionally considered the fact of quitting her job and trying to find her new job. And the thought of that really intimidated her because it was the financial security of her family, of herself, and she didn't want to rely on her husband's income to support the family. So she stayed, and Norman stayed, and no one decided to quit. So this cycle of rationalization occurred continuously throughout this fraud. During the first quarter of 2001, the telecommunications industry only continued to get worse. The revenues continued to decrease, and the line costs continued to increase. There's simply not enough market share to go around. For merely Q1 projections for 2001, WorldCom was going to miss earnings by $771 million. Once again, instead of simply reporting this, Sullivan came up with a scheme to portray the financial statements to reach their targets, but this time with an even weaker accounting tactic. Sullivan planned to capitalize the line costs, which, as we know from our accounting courses, they're considered operating leases. And with operating leases, you expense them in the period as incurred, and it is explicitly stated in GAAP that that is what you follow. However, he planned to capitalize the line costs, and then that means they get spread out over a longer period of time, reducing the amount of expense in the current year. These accountants also knew that it was illegal, and they knew that there was very little, if any, support for these entries. Yates initially refused to execute, but Myers and Sullivan said that this was the only way that they were going to make it through their accounting troubles. So Myers then sent down the order. Vincent was the one who had responsibility to make this entry. She said she would find a different job because she didn't want to make the entry, but reluctantly transferred the line costs. Now, in terms of the litigation, this was a very important decision because Vincent specifically chose which of the 5 capital accounts at WorldCom to put the line costs into. So because of this voluntary involvement, it was very important for the future litigation. So the industry continued to tank, and actual financial results once again yielded monumental losses for WorldCom. For quarters 2, 3, and 4, the estimated amounts of losses was going to be $560 million, $743 million, and $941 million. Every time that Vincent had to make the accounting entry, she convinced herself that it was going to be her last, and that she was going to quit her job, and that she wasn't going to continue at WorldCom. However, she was there for 3 quarters and did not. In addition, Buford Yates sought out a lawyer who he did not engage a lawyer because he was confused ethically on what to do. And additionally, Norman, he was distraught, so he didn't want to do the entries either. After carrying out another $818 million in fraudulent capitalized expenses in the first quarter of 2002, Norman and Yates discovered that these fraudulent entries were going to continue to occur through the end of 2002, and they decided that they had had enough. They made a pact that they weren't going to do any more improper accounting entries. Norman decided to quit, and Vincent and Yates decided they were going to find a new job.
All right. March 2002 is when Cynthia Cooper became aware of what they were starting to do. John Stuka, who was the head of the online business, came and told her that he was about to lose $400 million from his reserves account that he set back to pay for the bad debts his customers didn't pay. This was thought as an acceptable way to do this. Sullivan chose instead to take the $400 million and use them to improve income. When this happened, Cooper then went to Arthur Anderson, who said that it was all that was acceptable and nothing was wrong with that. And then when asked, Melvin Dick and Kenny Avery, who were the partners in charge from Arthur Anderson, they said that they would only report to Sullivan. March 7th, 2002, the SEC ran a cross-sectional analysis, which means it compared WorldCom's financial statements to the industries and their earnings. And from the overexpansion in the industry, everybody was losing money and companies weren't reporting very good earnings, but WorldCom continued to report a profit. So that gave them suspicion as to their numbers were wrong. Cooper then told Morse that he needed to go dig because that's what he did best, is to find information through technology. Also at this time, this is when Enron, the scandal, so that was a red flag to her about Arthur Anderson, and she then knew that the company was going to have to seek a new and external auditor. And then from May 28th to June 11th, this is when Morse accessed the computer system that was usually only able to be accessed by Sullivan. So this was all the stuff that Sullivan could see and nobody else was supposed to be able to see it. He found $2 billion in questionable entries from the first 3 quarters of 2001. Said they were spent into the closers on capital expenditures, which means that you can capitalize and you can set out the expenses over time by depreciating them over several years. When she asked, she was told this made-up word called prepaid capacity, and when she told them to explain what that meant, nobody could explain what it meant. She was just told to forget about it. And then what set them off is Morse eventually found $500 million charged to computer expenses, so which is an absurd number. So that's when they realized that something was really wrong and that the company was being fraudulent. June 11th, 2002 is when Cynthia Cooper asked Vincent, Yates, and Myers to explain these entries, and all 3 of them didn't have an explanation. So then she was referred back to Sullivan. So Sullivan called a meeting with Cooper, and in that meeting, Cooper discussed her findings about the capital expenditures, and Sullivan begged her to delay the audit. And of course, she denied, and then she reported her findings to the audit committee and Mr. Malone, which is now from KPMG.
Okay, so we're going to take a step back into the financial accountants and their actions. So upon being questioned by Cooper, Vincent, Yates, and Norman all got very, very intimidated and began to panic. So on June 20th, at Yates' lawyer from before Dr. Holloman, they planned to meet with regulators and prosecutors, tell them everything, and hope for leniency. However, this was a little bit weird timing because this was finally when they realized it was going to be caught. So this was when the ethical consideration came into, well, were they only reporting because they thought they were going to get caught, or were they reporting because they wanted to assist lawmakers? So on June 24th, the three told their story to the SEC, FBI, and the U.S. Attorney.
All right, so on the 20th is when Malone, who was from KPMG, the new auditor, reported the evidence to the board of directors. The board of directors then told Sullivan to explain himself. He said he couldn't, and they told him they'd give him the weekend. He came back, he couldn't explain himself, so he was asked to resign or they would fire him, one way or the other. June 25th is when Cooper discovered all of the $3.8 billion of fraud they committed, and 26th is when the SEC lawsuit started.
Okay, so now we're going to break down the fraud triangle for all the parties involved. So with Sullivan and upper management, they received pressure to perform from Wall Street analysts. They also had pressure of working at a top 25 company and being so well respected. The opportunity arose because only Sullivan had access to the computer system. In addition to, he was the CFO and could sort of command his accountants to do what he wanted, and they didn't do anything about it. And his rationalization was that this is during our rough financial times. Once we're out of our rough financial times, we will stop doing these fraudulent entries, but we're only doing it right now because we're hitting the rough patch. For the accounting crew, the pressure came from the upper management, Sullivan and Myers, to perform the accounting entries. And the pressure additionally came from, this was their livelihood, this was how they supported their families, and that they didn't know if they were going to be able to find another job. The opportunity arose because they were all in management positions as well, and there was a large amount of collusion because, especially with Arthur Anderson not following through, no one was going to catch him. And the rationalization, again, was we're going to find another job, we're not going to continue to work here, and we're going to, we're going to resign. So that was their rationalization.
All right, as far as Cooper, she had the opportunity because nobody else was looking into it besides her. She had the pressure from Sullivan to stop, but she chose not to and rationalized to be honest and do her job. So, according to the Sarbanes-Oxley and the Whistleblower Act, Cooper provided info related to fraud to a supervisory authority who has the authority to investigate, which was Malone. So she was covered under the Whistleblower Act.
Okay, so ethics related to Betty Vincent. We're going to discuss with that, we're going to discuss the Sarbanes-Oxley Section 806 under whistleblower protection, in addition to the IMA Statement of Ethical Accounting Practice. So in the IMA Statement of Ethical Accounting Practice, there is a section of how to resolve ethical conflicts. And in this section, there is instruction to continue to move your complaint up the chain of command, and you continue to go up to the highest chain of command until you reach audit committee, board of directors, board of trustees, etc., which Vincent did not proceed up to that level. She stopped when she got to Sullivan, which is not in line with the IMA Statement of Ethical Conduct. Additionally, she has options available to speak with an IMA ethics counselor, and finally, she could have obtained an attorney, which she did not. Under the whistleblower protection, she would be considered a whistleblower because the definition of the whistleblower is someone who has an employee who reasonably believes that there is a violation, and if she would have reported it to the audit committee, member of Congress, or federal regulatory agency, she would have been considered a whistleblower. Additionally, being a whistleblower, it should have dissuaded her fears of becoming fired, because if you are considered a whistleblower, no company may discharge, demote, suspend, threaten, harass, or in any other manner discriminate against employee in terms of conditions of employment.
All right, case questions, auditor's responsibility and fraud protection. First off, one thing they could have done is the analytical procedures when planning the audit, such as what the SEC did with the cross-section. They could have compared the industry, and Arthur Anderson would have saw that they should be reporting profits like this. Second, they should use professional skepticism, which is questioning mind and critical assessment of evidence. So they should have been questioning all these illegal acts instead of letting Sullivan influence them. Third, they should have been conditionally alert for misstatements. And Cooper did all these as an internal auditor, but Arthur Anderson failed to.
So in terms of what evidence should have indicated the fraud, there was plenty of evidence, like with the $500 million of expenses for computer costs. Like that's just a ridiculous amount. But this evidence was not being detected because Arthur Anderson was colluding in on the fraud. And there's really no one to catch them.
SEC consequences, they had to have a corporate monitor. His name was Richard Breeden. They had to go through a training and education program. They eventually had a civil penalty of $2.25 billion, but since they had a bankruptcy, they settled on $750 million. And they had an extensive review of governance and internal control. And this was all from the litigation from the SEC.
Okay, so where are they now and what were their sentences? So the guy who ended up with most of the slack from it was actually the CEO, Bernie Ebbers. He received a 25-year prison sentence in Oakdale Federal Corrections Institute. And Scott Sullivan, the CFO who orchestrated the scheme, only received a 5-year prison sentence and was released in 2009. David Myers, he received a 1-year sentence and now lectures about his experience and recently lectured at Baylor University. Buford Yates received a 1-year prison sentence, as did Betty Vincent, and she is currently an accountant at a KFC franchise.
Cooper now has her own website and speaks publicly about ethics, and in 2008, she wrote her own book called The Journey of a Corporate Whistleblower.
That concludes our presentation.
Any questions?
Why do you think the external auditors didn't catch it when they went on it, or did
Yeah.
they not do something?
Do you want to cover that one?
Yeah, they were, it was Arthur Anderson, and apparently they didn't catch it. They said that they're only going to report to Sullivan. So when Cooper tried to tell them the obvious misstatements and the suspicions of this, they said they weren't going to talk to her because they only took orders from Sullivan. So therefore, I'm saying that if Sullivan didn't tell them to do something, they weren't going to do it. That's from all the articles we read and all the research we did. It was all, we're not going to do anything unless Sullivan tells us to. Anybody else?
Yes.
Okay, so if you were in Betty Vincent's position, would you feel the pressure to do the same thing, or do you think that you would try and be a whistleblower?
Well, I mean, it's such a difficult question because you see people as successful as she was, and she was hardworking and diligent. She taught Sunday school. She had a husband. You know, she wasn't like in any way different than any of us. So the duress and the pressure of A, just having a job, and B, coming into a situation with corporate fraud like this, like, cannot be understood lightly. I think that's a huge deal, especially if Sullivan was such a good CFO. And you sort of question, well, maybe he's right, maybe he knows something I don't, whatever. In addition to the fact that in the Maslow's hierarchy of needs, the basic need is providing for yourself. So in providing for herself, her salary's gone. I mean, she was freaked out about it. So the amount of dread that goes into this decision, I completely understand. But where I would say that I would follow through and whistleblow is knowing the protection in the Sarbanes-Oxley Whistleblower Act. You can, if you have reasonable expectation that it's incorrect, then, and you present that, no one can come after you from in the company to take your job away. So if it turns out it's incorrect, which would be my biggest fear, which would be, okay, I think this is wrong, but if I say it's wrong, there's a huge scandal, the company gets in trouble and it's me, I'd be worried that they'd come after me, but they can't because of the Sarbanes-Oxley. So because of that protection, it makes the decision a lot easier to become a whistleblower.
Hey, bring up your dates on your slides. Just back up, just back up. I'll timeline of events. Any of them. Okay. When was Sarbanes-Oxley passed?
Let's see, I have it right here.
Wasn't it after this? Wasn't it?
It was in 2002, I'm not for sure on the exact.
Actually, the whistleblower provisions of Sarbanes-Oxley were put in place because of Cynthia Cooper. So your question of what would you do if you were Betty Vincent is very valid. And they brought it up. Her husband's job was not stable at the time. He didn't have insurance, did he?
It said that she was a breadwinner. She made like $20,000, and he.
Additionally, she received a promotion during all this.
Right.
She was compliant.
And so when you consider this, there were no whistleblower provisions. her husband didn't have health insurance. She was the health insurance coverage, and his job was very unstable. So, you know, when you go to criticize her, remember that that's the decision she was operating under. But also remember, she ended up in sentenced because of it.
Yes.
So go ahead.
My question kind of goes along with that one, except for I was looking more at Cynthia Cooper than I was at Betty Vinson. Because her husband didn't have a job, and she had, I believe, 1 or 2 children. So she was the sole breadwinner. Like, her husband didn't have a job whatsoever. So what do you think motivated her to come forward? I mean, she didn't participate in the fraud, but she was bringing forth that the company that she worked for had been committing a fraud. What if they lost a bunch of, customers because of the fraud?
I just feel, I read something that she felt that it was when she was given, and when Evers gave her the job to be an internal auditor, she was just fulfilling her job that she was given, and she rationalized that this is the job I was given, and I'm not going to be criticized for doing the job I was given, and she rationalized that I want to be honest, and that's just, she said that everybody else was following into the footsteps of Sullivan and giving in. She didn't want to be that person. So,
additionally, considering the way that she was for the article, that like when someone told her, don't worry about it, it's not your job, don't consider it, that just motivated her. So it was more of her personality and the way that she was that motivated her to continue to investigate it. And so, I mean, because then once again, when she did realize that the fraud was going on, I mean, she was nervous. She was calling her family. She said, I'm scared, I'm about to do something that's going to upset a lot of people. And so she knew what she was doing was bad, but she also understood that her role as an auditor was, and within the company, being the auditor, she just did the operational audit, so she wasn't as much financial. But, I mean, as an auditor, that's what you're supposed to do. So,
the first time she brought it up, Sullivan screamed at her. I think Time, I believe, is the magazine, she told that abrupt action just makes her motivated to look into something like that, because most people shouldn't get so upset about just me asking you about something. So I agree with him, more of her personality that she wanted to do that.
Yeah, and then she just kind of uncovered something that she kind of, sure hoped that she didn't, but then when she did, it was like she knew about it. And that was why, when I look at Cooper and Vincent, I say part of it's their position, because Vincent's just reporting the financial statements, whereas Cooper was more outside of that and more as an auditor. So within her position, it might be a little bit easier to do something, although I would still credit a lot of the testimony that she was. Rachel wants to say something.
If Cooper decided to go along with their whole plan of fraudulent accounting procedures or whatever, do you think that the company could last longer? Why or why not?
I don't believe so, because she, for one reason, they changed external auditors from Martha Anderson to KPMG, and Daryl Malone, the guy from KPMG, was when she first started the events, he was all over it, and he was following his responsibility. So I feel like even if she would have changed and went with the fraud, that the new auditing firm would have successfully used the techniques they needed to do to find this out, because they weren't motivated by Sullivan like Arthur Anderson was.
And additionally, the SEC had begun to investigate. So it wasn't like it was just internal. The SEC was starting to get red flags that there's no way that these were real, that there's no way this performance could continue. So the SEC, in tandem with KPMG, probably covered it.
My question's similar to Tori's, but it's a little different. Kind of basically, other than their likelihood, what kind of thing, do you think there's anything else that led to, Vincent and those other accountants who are making the entries, continue to make the entries and not come forward?
Yeah, well, I'd say the reason they didn't make the entries is because they didn't foresee themselves getting caught, because it worked. You know what I'm saying? They did the entries, they did everything, and there was no real consequence. Even though they continue to know this is wrong, they're like, well, if I continue the way that I'm going now, nothing has really happened, even though it might. And just that temporary satiation of that fear of that not being there and being, okay, I can still provide for my family, I still have my job, I still don't have to confront this. being able to push that back was, I mean, that was why they did it. It wasn't because they convinced themselves it was right, but it was because they convinced that their need for supporting their family was greater than their need to do this. And then because they weren't getting caught. And that was why I thought it was so suspicious that they then went and reported to the SEC when Cooper asked them. So as soon as they were like, oh God, this is gonna come out whether we say it or not, they were like, okay, well now we're gonna say it. But the court in New York, the reason they were guilty is because they viewed that as confession rather than tipping them off. Because of what I would assume to be the fact that they knew they were probably gonna get caught. So then they admitted to it instead of, if it was a tip-off, they wouldn't know that the walls were crashing down. You know, so that's why I think that it would be, yeah, but in any case, yeah, that's why they didn't do it, it's because they didn't get caught.
That answered my question. I just wanted to know. You thought like intentionally turn them in sooner than to keep doing it.
It's just such a big thing to do. Like, especially now knowing that Sarbanes-Oxley was before this, like, to turn in your bosses, to risk your family's longevity, all those things, to do what you know is right. I mean, it's a really big thing, and you would assume if I told you she was a son, if you didn't know that she didn't do it, and I said a Sunday school teacher who's a mom and a wife, who lives in this nice house, and whose reputation within the company was good. She was a good employee, she was diligent, and she worked hard. So all those things were like, yeah, she's probably a pretty good accountant. But then when it comes to something as basic of a need as to protect your family, I mean, that's a powerful thing to balance. So.
Of all the incentives, which one do you think was maybe the biggest incentive for the fraud? Of anyone you want to?
Well, the whole drive of it came from Evers and from Sullivan, because
Why?
as the CFO and the CEO, they needed to hit, they're in charge of the company. They got this prestigious position, well, because Evers grew with the company, and Sullivan was there, and they had these prestigious positions, and they were in charge of these numbers, and they kind of felt the success of the company was with them. So as it began to decline, and they sort of realized that they weren't going to make money, they couldn't face the fact that their company was going bad, and it was their fault. Well, it really wasn't their fault, it was more of the industry's fault, but they just didn't want to see their company go down. So that incentive to make the numbers look good, for their success as a man and as a person, that really drove them to say, okay, I'm not reporting the failures, I'm just making this, I'm making this good.
I feel more of the Sullivan's ego. When he saw that first, when the Wall Street Journal said that they were going to make the projected earnings were like $820 million that first quarter of the year. He just felt like, well, we've never missed earnings before, like it can't happen now, even though everybody else was. So that's when he came up with his scheme, and then he just kept doing it 7 or 8 quarters in a row and caught us.